Hello and welcome to our investment strategy series. After a year of strong performance and low volatility, investors are wondering whether the end of the cycle is nigh. Our answer is not yet. Two factors can break economic cycles: an external shock, unpredictable but unlikely, and an internal feedback loop where the economic engines overheats due to price pressures or excessive investment spending. Policymakers then react by pulling the brakes, and expansion becomes a recession. But we see no signs of inflation or investment excesses in the global economy. 2018 is therefore likely to be a year of continuity with above-trend growth. Although it should be a pivotal year in monetary policy, central banks are cautious in their removing of ultra-easy measures. This means that financial conditions remain broadly supportive. Solid macro momentum and available liquidity should continue to lift corporate profitability in 2018. While the business cycle is maturing in the US and Japan, Europe and emerging markets have room for more upside. Earnings are quite remarkable in most regions, particularly in Europe, whose economy has proved resilient to political concerns. These powerful global trends continue to support emerging markets. China has enough momentum to sustain a slightly lower growth rate, and Latin America may turn out to be the region with the most potential. And so, continuity prevails as 2018 dawns for investors. But continuity does not mean more of the same. Unlike 2017, where real economic activity surprised on the upside, inflation could play a major role in 2018. So let's hear from Stéphane what this means for investors' opportunity set.
The market's impressive performance begs the question, should investors fear current valuations? We don't think so, as valuations are backed by strong earnings dynamics, consistent with the current economic backdrop and the benign inflation regime. Now, of course, volatility could increase if inflation firms up. Our outlook of slightly higher inflation also means that bond investors are facing a different set of dynamics. So, we have redefined the fixed income allocation to favor the segments with better relative value by limiting exposure to government bonds, European corporate credit and high yield, and by increasing allocation to emerging market debt in local and hard currencies, as well as to convertible bonds, which allow investors to benefit from heightened volatility and potentially rising equity markets. Our equity exposure mirrors the business cycles described by Samy just before. We favor the dynamics of cyclical regions with catch-up potential, such as Europe and emerging markets. The world's most cyclical market, Japan, should remain driven by the global momentum. Japanese equities upswing should continue in 2018. We expect cyclical stocks, such as energy and materials, to outperform defensives globally. Substantial value can also be found in small and mid caps in Europe as well as in the US, with the tax reform acting as a catalyst. We also look positively at commodities, a good diversifier in a period of rising geopolitical risk and potentially higher inflation. In currencies, the strength of the US dollar has now reversed. We continue to favor the euro and select emerging currencies against the US dollar. We see no major shift in the valuation of the Swiss franc and the British pound. Both currencies should remain reasonably stable versus the euro in 2018. Looking further ahead, the yen could put a new twist on the FX markets by a sudden appreciation under a risk-averse scenario. We are thus embracing a wide growth-oriented opportunity set to make the most of our outlook. It also means that we will be closely monitoring factors that could derail our scenario. A pickup in inflation above 2%, monetary policy missteps, upcoming elections in Italy and the US midterms, and more broadly, geopolitical risks, namely the situation in the Middle East and in North Korea. We'd like to end this strategy update by wishing you and your family a very happy holiday season and every success in 2018. We look forward to keeping you regularly informed about our outlook and major developments in the global markets in 2018. Thank you very much for watching.